Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Good morning and welcome to The Bigger Picture. I'm Dan Koh. Now, quantitative investing has been steadily gaining traction here in Asia, with investors seeking more data-driven approaches to navigating the increasingly complex and volatile markets. And one area that has drawn particular attention is low volatility equity strategies that's designed to balance growth potential with downside protection. So to tell us how to navigate this space and find the opportunities that are presented to us, I'm pleased to have with us in the studio Christopher Hughes, the quantitative equity strategist at Eastspring Investments. Good morning, Chris. How are you doing today?
Hi, Dan. Great. Thanks for inviting me.
Yeah, pleasure to have you on with us. Now, Chris, you manage the Asian Low Volatility Equity Fund at Eastspring Investments, and that's a fund for investors who are seeking for total returns in line with Asia-Pacific ex-Japan equity markets. So could you explain to us very briefly the core principles behind your fund and how it differs from the traditional equity strategies that are available in the market today?
Okay, maybe the first place to start is to talk about what volatility is. So volatility is, if you can imagine a stock price over time, you've got a sort of cone that goes around the stock price. You can draw a sort of tunnel around it. And the size of that tunnel represents the volatility. So highly volatile stocks would have a very wide tunnel, and low volatility stocks would have a small tunnel. Well, what does that actually represent in reality? What it means is that the stocks with a smaller tunnel, they have much more predictable returns. Their business models are much more proven. So you'd be thinking about things like utilities, consumer staples. And then at the other end of the volatility spectrum, the high volatility stocks would be things like technology stocks, maybe some of the AI stuff, because there's a lot less certainty around them. The thing about the high volatility stocks is because everyone is so excited about them, they talk to people at parties about them. It's all the...
Yep, it's all over the news.
Yeah. So they tend to be much more richly valued than the low volatility stocks. So over time, what you find is that you get a much smoother ride through the market with a low volatility portfolio, and you tend to get a much more value-based portfolio.
Right. Fantastic. That's a good breakdown of that. Thanks a lot, Chris. Now, in periods of heightened market volatility, how exactly does your low volatility strategy help in generating alpha and protecting investor capital then?
Well, I think the thing to point out is that at those high volatile times, what's actually happening is that those stocks that are moving massively, the technology names, for example, if you think there's a range of possibilities of the prices of those, and at the height of the market, it tends to be that everyone's super optimistic. But when things get very volatile, everyone's thinking maybe these things are going to crash to the ground. And so you tend to see those move down much more. But low volatility stocks, because they have more predictable business models and they're more dependable, generally more recession proof, they tend to move less. So it gives you some alpha protection in those volatile periods.
Wow, that's great. And it helps you sleep a lot better at night as well.
Yeah,
exactly. So now let's talk a little bit more about an investment strategy that's been picking up lately. Then that's quantitative investment, a systematic strategy that removes much of the emotional element when it comes to investing. But for the less informed, how would you define quantitative investing today?
Well, quantitative investing is really using computers and a lot of data, a lot of history of stocks and statistics and patterns that people have seen in markets over generations, and applying it all across a large range of stocks. So we tend to take much less large bets than, say, a fundamental investor who concentrate on maybe 20 or 30. We will have, say, 200, 300 stocks, and we'll take smaller bets in each individual one. But that's because we probably have less insight into those stocks. You know, things like knowing the future, knowing what's going to happen with strategy on products and who the new managing director is. That's the sort of blind spot a bit for quant. So that's why fundamental investors who feel they know more about that will put larger bets. But we will spread the bet across a larger range of stocks and sectors. Right. And so we're much more risk controlled as well.
Yeah, it's pretty mathematical if you ask me. Now, how then does quantitative investing in Asia, particularly here in ASEAN and Singapore markets, present unique opportunities and the challenges as compared to, say, maybe the more developed markets?
Okay, well, it used to be quite challenging in Asia. And the reason for that was because there used to be difficulties getting data, there would be different accounting standards, all of that sort of stuff. But actually, the good news is in the last probably 10, 15, maybe even 20 years, things have got much, much better. And a lot of the data providers have moved into the Asian region. They started off, obviously, in the US and Europe. And so, actually, Asia, I would say, is probably as easy to do quant investing in as North America and Europe, which didn't used to be the case.
Yeah.
But the nice thing about it is because it's such a retail-driven market, these quant factors tend to work much better in Asia too.
Oh.
So you actually have the advantage of having a less crowded trade,
Yeah.
and also having all of the data you get in the developed markets.
Yeah, but would you say that since it's not as developed, the data that you have to work with may not be as comprehensive as you would with a developed market?
I think accounting data is generally quite good, and it tends to be that we're focused on. There may be some issues with languages and stuff like that,
Yeah.
particularly on earnings calls if
Yeah.
it's not in English. But some of that is being solved by AI and the new technologies that are coming through.
Yeah, for sure. All right, thanks a lot for that, Chris. Now let's start to demystify some of the common misconceptions about quantitative equity investment, especially in the context of Asian markets. What are some of the common misconceptions you think investors might have about quantitative investing then?
The biggest misconception people have is that it's a black box, that there's a computer somewhere that's just spouting out trades, and nobody knows why it's happening. And actually, I think nothing could be further than the truth. I mean, what we're doing is actually mainly statistical and looking at these patterns that academics have identified over generations. And actually, you could do the job with a pencil and a piece of paper if you had long enough. So the computers are not the sort of mysterious part. They're just something that allow us to scale, and it allows us to look across, a much larger range of securities than, say, a fundamental investor could.
Right. Okay, then now, how do you incorporate factors like market noise and macroeconomic uncertainty, seeing as you're using mainly mathematical equations to help you with your trades and your investments? How does that help to improve investment outcomes when it comes to market noise?
I would question the question in some ways, because we tend to think that what we're trying to do is invest in these long-term trends, these patterns that have been established over time. And so what we don't want to do is move away from those patterns very often with sort of market noise, particularly, I mean, as you've seen even this year with the tariffs.
Yeah.
You could have reacted and then immediately the market went back up. So there's trading costs, there's all sorts of things associated with that. So if there is something specific about a stock, then we will try and do something about that. Say the CEO is arrested for fraud or something like that, we will probably do something about it. But generally, we try and stick to our strategy. And if we're going to change it, we try and backtest it. That's the nice thing about quant. So we can change the strategy. We can look at what would have happened in the past. We can sort of play the scenarios out, and that helps us to be sure about what we're doing rather than just reacting immediately.
That's fantastic to know that at least you're sticking to your core principles.
Yeah.
So then, with the increasing adoption of AI and machine learning in finance, how do you see this evolving, the role of quantitative investing in perhaps in foreseeable future?
I think it might change quant quite a lot. I mean, what has happened over the last 20 or 30 years is a lot of fundamental investors have moved to a more quant direction. They've started using screens and things like that, but quants haven't really moved in that direction because it involves a lot of people.
Yeah.
But I think the opportunities, for the blind spots that I mentioned earlier, things like knowing about product launches, knowing about new hires in the company, reading, we do have some sentiment data, but sort of having more responsive news from people like you, actually.
Right.
And incorporating that into the strategy. I think that sort of stuff will go into quant in the next 5 or 10 years.
Fantastic. Now, Chris, before we let you go, here's the golden question. Now, for retail investors who are looking to perhaps maybe get their hands dirty in quant investing, what are some factors or key factors that they should know before getting started and before perhaps even including it as part of their portfolio?
I think one of the things that they should understand is that quant investing tends to be more statistically based, so we're not taking large bets in individual stocks. And that means that they have a different position in your portfolio than, say, a fundamental fund, which is very, very concentrated. Mm-hmm. So I would think of it more as like a football team, maybe, where you've got, different players playing different roles. Maybe you want to have a few strikers, but you don't want to have a team full of strikers. You want to have some defense. You want to have some midfield. That probably goes to the extent of my football knowledge, actually. But anyway, so I think you want to have a range of funds, and I think you want to understand what those funds do. And quant funds, low volatility, for example, will behave slightly differently to an index fund.
Yep.
And what it will do is smooth the market out, as I was saying earlier.
Right.
And that can be quite nice if you're saving for some sort of long-term goal and you don't want to have some large drawdown halfway through.
Of course.
Now, obviously, we can't guarantee anything about no drawdowns, but generally over time, historically, that's tended to work.
Yeah, after all, timing the market, it's not really exactly the way it should be. It's about time in the market that we should be paying attention to. So thank you so much for joining us today, Chris. It's been a pleasure having you on to talk about quantitative investing today.
Thanks a lot, Dan.
All right, we've been in conversation with Christopher Hughes, the quantitative equity strategist at Eastspring Investments. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.